Ladies and gentlemen, good day and welcome to Gandhar Oil Refinery India Limited Q3 and 9 months FY26 earnings conference call hosted by MUFG In Time Private Limited. As a reminder, all participants' line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star and then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Ayushi Gupta from MUFG In Time Private Limited. Thank you, and over to you, Ms. Gupta.
Thank you. Good morning, everyone. I welcome you all to the Q3 and 9 months FY26 earnings conference call of Gandhar Oil Refinery India Limited. To discuss this quarter's business and financial performance, we have from the management Mr. Ashlesh Parekh, Joint Managing Director, and Mr. Indrajit Bhattacharya, CFO. Before we proceed with the call, I would like to mention that some of the statements made in today's call may be forward-looking and may involve risk and uncertainties. For more details, kindly refer to the investor presentation and other filings that can be found on the company's website and on the stock exchange. Without further ado, I would like to hand over the call to the management for their opening remarks, and then we can open the floor for Q&A. Thank you, and over to you, sir.
Thank you. First of all, good morning to everyone who is joining us on this call. I am Ashlesh Parekh, Joint Managing Director of Gandhar Oil Refinery India Limited. I am joined today by our CFO, Mr. Indrajit Bhattacharya. We appreciate your time and participation as we discuss our financial performance for the third quarter and the 9 months ending 31st December 2025. I'll begin by sharing our perspective on the operating environment and how our business has performed amidst a dynamic economic landscape. The global white oil market continues to exhibit steady structural driven growth. Based on the recent industry estimates, the market was valued at approximately $3.6 billion in 2025 and is expected to be around $4.66 billion by 2034, expecting a CAGR of about almost 3% over 2025 to 2034 period. This growth is underpinned by the essential role of white oils in regulated and performance-sensitive applications, where consistency, safety, and compliance remains very critical. Regionally, Asia Pacific remains the largest contributor to the global white oil demand, accounting to over 40% of the total consumption, supported by industrial expansion, rising healthcare usages, and growing personal care adoption. At the same time, developed market continues to demand higher quality grades due to tighter regulations. This dynamic aligns well with Gandhar's policy and operating strength and reinforce our position within the global white oil value chain. During the third quarter FY26, Gandhar recorded a consolidated revenue of 1,167 crores, reflecting a healthy year-on-year improvement of 16% and quarter-on-quarter growth of 10%. For the 9-month period ended FY26, the total revenue stood at around 3,130 crores, demonstrating stable performance despite the challenging macroeconomic environment marked by pricing volatility and logistical disruptions. International market continues to play a very important role in our overall performance, with overseas sales contributing to around 45% of the consolidated revenue during the 9-month period. This sustained contribution from global market underscores the strength of our international customer base and reflects the steady progress we are making in expanding and deepening our global footprint across key geographies. With this, I would now like to hand over this call to our CFO, Mr. Indrajit Bhattacharya, who will take you through the financials in detail. Thank you once again, and over to you, Indrajit.
Thank you, Ashlesh bhai, and good afternoon to all participants. Let me take you through the financial highlights for the third quarter and 9 months ended FY26. On a consolidated basis, revenue for Q3 FY26 stood at 1167 crores, reflecting a sequential increase over Q2 FY26 and healthy year-on-year growth of 16% compared to Q3 FY25. For the 9 months ended FY26, consolidated revenue stood at rupees 3130 crores, supported by steady volumes and consistent demand arose across markets. EBITDA for Q3 FY26 was 59 crores. While this represents a moderation compared to the strong performance in Q2 FY26, it remains significantly higher on a year-on-year basis. For the 9 month period, EBITDA stood at 171 crores, underscoring the resilience of our operational performance. Profit after tax for Q3 FY26 was rupees 34 crores, compared to rupees 40 crores in Q2 FY26 and rupees 20 crores in Q3 FY25. For the 9 months ended FY26, PAT stood at rupees 100 crores, reflecting a strong improvement over the corresponding period last year. Our segmental revenue mix for 9 months FY26 remained well diversified, with PHPO contributing 50%, followed by lubricants at 26.8% and PIO at 9.5%. The manufacturing gross margin spread for Q3 FY26 stood at rupees 7,271 per KL, underscoring the strength of our manufacturing efficiency and disciplined operating execution. We remain focused on a prudent cash flow management and operational efficiency as we navigate a volatile global environment. With this, I conclude the financial review and would now be happy to take your questions. Thank you.
Thank you. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rohit from iThought PMS. Please go ahead.
Am I audible?
Yeah.
Good morning, sir. Thank you for the opportunity. So, sir, just 2-3 questions. One was, so if I look at the history of our company over the last 7-8 years, our operating margins have hovered between 2-3% to about 7-8%. And right now we are about 5% in this quarter. So just to understand, I understand our gross margins are pretty low. So, I mean, when you look at your business, what is the general operating margin that you would sort of say that this is a normal operating margin for our business? I know it can fluctuate a quarter here and there, but I'm just trying to understand on a normalized basis. How do you see?
So by operating margins, we'll be talking about EBITDA. We're looking at EBITDA in excess of about 5-5.5% annually, and we expect it to keep going up from now. I mean, all other conditions, all other circumstances remaining the same.
Okay. And so there are some other, some of your peers who are also listed, and I was trying to sort of compare. So we are more focused on the personal care and healthcare segment. So any specific reason for that? I mean, and also if you can sort of comment on where the margins are better, where the sort of customers are more sticky. I mean, there are other segments like transformer oil is there, paraffin is there. So if you can maybe just explain if you can just give an overview about these other segments and why we've chosen on the performance personal care segment.
Sure. See, Gandhar oil is not only focused on PHPO as a product matrix, but we also are having other products in our portfolio, including the transformer oils, including the rubber processing oils, including the lubricants. The value share, across the value chain, if we discuss, around 50% of the total contribution is still from the PHPO sector, which is the personal care, healthcare, performance oil segment. The other businesses are also growing. PHPO as a business, I mean, obviously, last 1.5 to 2 years, obviously, the cosmetics and the pharmaceutical industry has not been doing so well, because of the domestic consumption. We anticipate the consumption, to move up. I mean, after discussion with our, various FMCG customers, they are also anticipating a pickup in demand, post GST rate cuts, post increasing liquidity, in the system. So we are highly hopeful that the FMCG sector will turn around very soon. Having said that, most sticky customers are in the PHPO business, where the entry to a customer is more than like 7 to 8 years of time frame. And once you are there with the customer, we grow with the customer. That's what we have even experienced. So, and with, if you see the other businesses, it's more of a price sensitive, price driven business. For example, say transformer oil, it's purely a price driven business. It's a tender business. The margins are pretty low, and even the debtors, even the collection from this segment is pretty high compared to the PHPO segment. So the focus will still be on the PHPO segment. Having said that, we are also not only dependent on our domestic customers, we are also dependent on our overseas business, which is also contributing to around 35-40% of the total revenue of the company. We are on verge of adding some new products also to the pipeline, and we are very hopeful that our EBITDA margins in the near future will definitely go up.
Got it. So just on this question on the volatility of raw materials. So how does it work, sir, in terms of because these are all crude oil derivatives. So base oil pricing, how does it work with your customers?
So see, base oil is the KRM, for any of our product mix, wherein we have term contracts with our suppliers, for annual offtake of our base oil to service our customers. So with suppliers, we do have pricing formulas in place. With few of our select customers, we do have price pass-through mechanism, wherein changes in the raw material price, changes in the forex price are passed on to our customers. Only few of our spot customers, we have a pricing on every 15 days, every fortnight mechanism, wherein any change in the price, is passed on to the customer on fortnight basis. Having said that, we have more than 4,000 plus set of customers, so the repeat orders from this customer is more than 75-80%.
Yeah. So with like sticky customers, we have a history of about 70% of repeat customers for the last 3 to 4 years.
So you're saying that with few customers we have pricing contracts, and with few customers we have like a 15-day price change that happens every fortnight. We change the price.
Yeah.
So what share would be where we have these pricing contracts where we'll have a formula and any change will sort of automatically get accommodated? What percentage of our revenue will be coming from these customers?
Around 35% of the business is on that price pass-through mechanism. The residual are on the other mechanism.
Got it. And so this last question before I fall back in the queue. So if I look at your EBITDA this quarter, it improved both sequentially and YOY as well, which you explained. But in your presentation, you've given the per liter EBITDA also that has been broadly in the same range, but the improvement in EBITDA has been much more. So what has led to that? I mean, I see that other expenses are significantly reduced, both sequentially and YOY. So just if you can just explain what was that?
So obviously, expense is one part of it. We've been able to, handle our finance costs effectively well, year on year, quarter on quarter. Over and above that, obviously, we've been in a position, to better sell our product and also efficient buying, from our suppliers. So this has been, combination of various factors which has led to this.
The main driver for any change in EBITDA or even PAT is the gross margin of our products, because this represents practically 75 to 80% of the cost. So in 1% move here or there has an impact on the bottom lines. So that is why one of the main reasons is that we've done better on the gross margins.
Got it. And so one thing was that, so a rising crude base oil price is beneficial for you, or a falling base oil pricing environment is beneficial for you, on a rule of thumb basis, whatever you've seen in the last 7-8 years?
Yeah, I mean, it's difficult for me to, give you a specific comment because, we don't play on the raw material price. Our focus is purely, customer-driven attitude, wherein, we focus on customers, their requirement. And we have a lean inventory of around 40, 45 days at the most. So, and whatever buying is there, I mean, 80% of the product is pre-sold, So, really, I mean, unless in very exceptional situation, when like crude goes up from $30 to $200 a barrel, or vice versa, it may impact. Otherwise, if it is range bound, it's not a problem.
Got it. Thank you. I'll fall back if I have more questions. Thank you very much.
Thank you.
Thank you. Participants who wish to ask a question may press star and one. The next question is from the line of Mr. Ritesh Poladia from Giri Capital. Please go ahead.
Thanks a lot. So my question is, your manufacturing gross margin from your own presentation, it's like 12-quarter low. So the improvement would not be from this gross margin spread, it would be from other expenses. So if you can elaborate on what has led to fall in the other expenses, that would be very helpful for us.
Hello, just a minute. Let me remove it. So, if you see quarter on quarter, or if you are going to see year on year, the major improvement has happened on other expenses, which is reduced from 52 crores in 31/12/24 to 37 crores this year. Even finance cost has slightly improved. Employee cost has gone up, but the major improvement is on account of other expenses, where the major component would be freight.
And where do you see freight now? Is it stable, or again it's inching up from this geopolitical situation?
So currently the freight rates are pretty stable, and there is no such unexpected hike that we experienced, previous quarters. And
sure.
Just to add, our gross margin in quarter 3, in number term, on a standalone basis, for example, has improved from 18 crores in 17 crores in FY25 quarter 3 to 36.3 crores in FY26 quarter 3. So obviously there has been an increase in the overall performance of the company. So it's just not only the expense reduction, but obviously increasing on the performance as well.
Yeah, but your per liter gross margin is about 12-quarter low. In fact, if we see from IPO times, it used to be hovering at 10,000 rupees per kiloliter. Now it's about 7,200. So is it because of the range bound oil prices, or is there any other reason like increased competition or anything you can elaborate on that?
Yeah, I mean, if you see the pre-IPO, around IPO, obviously these are all COVID, post-COVID numbers and all that stuff, But post that, if you see last 2 years, majority of chemicals, specialty chemicals, I mean, across the industry there has been, a revision in the profitability quarter on quarter. I mean, we have been also, part of the same cycle. But we are trying, we tried our level best, to maneuver around and, ensure that the margins of the companies are protected, and and in fact now we have started improving. If you see last 3 quarters compared to previous year, our profitability has increased. Our gross margin also have substantially increased.
Also, if you can guide us on current ruling white oil prices and where do you see it is going?
7,800.
So can you repeat your question? You are talking about.
If you can comment on the current ruling white oil prices during the month of January, and where do you see it's going?
January. So I mean, its range was around the 70 to 70,000, 72,000. Around 78 to 80,000 rupees per metric ton.
Okay.
And we
so it's yes, sir. Please go ahead.
No. So we anticipate the price to be, little bit going up, I mean, based on the raw material increase and the forex increase as well.
Sure. Also, if you can comment on your CapEx, I think there is some delay from the whatever you envisaged in the IPO, or is it on a time frame? If you can quickly take us through that.
No. Delay in the capex.
So I think in the IPO, whatever their plans, is there any delay or all your capital expenditure?
It's all done. All the money has been expended, and all the capex has been put into place. All the other objects have been met.
Okay, so 6 lakh liter is your now 6 lakh kiloliter is your capacity, which will be there for some time now, right?
3 plants. In the 3 plants, yes.
Okay, and what will be the utilization for the Sharjah?
Sharjah is currently around 70-72%.
Sir, India has about almost optimum utilization, but Sharjah is a bit low. Is there any structural difference in that?
So Sharjah is basically a new plant. I mean, it got operationalized sometime in 2017 or 2018. Okay. Now, as Ashlesh Bhai had explained, getting onboarded with these marquee names or the big players takes nothing less than 6 to 7 years. So that process is on. Second is, even the raw material supplies for Sharjah are also in the process of being set up. So it will take another 2.5 years for Sharjah to come online or close to the 90-95% this thing. Till then, this is the normal course of business. The customer accreditation is happening. I mean, accreditation by the customers is happening, and the raw material lines are being set up.
Sure, sir. Also, if you is there any other expansion plans you are currently going through, or right now it's a status quo?
It's difficult for us to comment, but obviously, as you have seen during the board meeting, obviously the resolutions are now available publicly. We are planning to purchase some additional piece of land in both our facilities, for expansion. So maybe we'll be, in a position to give you more clarity in maybe a quarter to come as well, with the amount of expansion planned and the quantity and the value of capex plan.
And in the capex, you will have the regular maintenance capex, debottling capex, that will happen, and some additional tanks are being put up. So I mean, storage.
No, but the new capex will definitely be coming by maybe end of this year or early next year at the most.
Sure. And final last question, what's the status of this Vadhavan Port project for you? There was like a non-binding MOU, but if you can give us some idea what's happening over on that side?
The tenders have still not been floated, by the government as yet. So we are persuading them, and as soon as we have some information which we need to pass on to our shareholders, definitely we'll be doing so.
And what kind of investments would be that? Is it for the chemical storage side, or is it from your own this existing operation side?
It will be a combination of both.
Okay. Yeah, that's all from my side. Thank you very much, sir.
Thank you.
Thank you. The next question is from the line of Mr. Bhavesh Patel from Patel Investments. Please go ahead.
Hi. Thanks for the opportunity and congratulations on great set of numbers. The turnaround is visible and hoping for better numbers going ahead. Also felt great to get the dividend of 75 paisa. Appreciate especially the comment in terms of continuity of quarterly conference call based on the input in last call. So thank you, Ashlesh Bhai, on that. And I like the details provided by both Ashlesh Bhai as well as Indrajit. I have following couple of questions. Number one, our company reported record-breaking revenue this quarter, so congratulations on that. Yet the manufacturing gross margin spread, which is INR per kiloliter, contracted from 8662 to 7271. Can you please explain this, and do we expect this situation to be continued?
So this is basically an impact of the raw material prices also, and the the fact that what Ashlesh bhai mentioned, that FMCG and pharma, with our regular customers, we've not been able to get the prices which we were getting earlier. So these are the main reasons why the gross margins has been slightly impacted. Going forward, yes, the whole of this year we've been getting in excess of 7.5 rupees per liter. Going forward, we would like it to be close to 8, but it should stay around 7.8, 7.9 rupees per liter.
All right. Thank you, Indrajit, on that. The next question is, the board, the meeting came out, right, in terms of minutes. It said approved the purchase of 453 decimals of land adjacent to your current factory. Now, I really don't understand what is this 453 decimals. Is it in terms of acres or square meters? And where have you purchased this land? At Taloja, Silvassa? I mean, which place?
So these are lands being purchased at both the units at Silvassa and Taloja, adjacent to our existing factory. Now, as regards the decimals, we'll get back to you in the course of this call itself. What does decimal mean? I don't know if it's guntas or 0.4853 acres. I'll just get back to you on that.
Yes, please. That will be appreciated. So we are saying we are buying at both the lands, both the plants, in terms of adjacent land for expansion. Now, right. I know Ashlesh bhai mentioned about strategic plans for the timeline as well as amount for the further capacity addition. But my question is, without the upcoming capacity expansion with the land that we purchase, are we still continuing with our increasing volume by 10-15% over next 2-3 years on a yearly basis?
Yes.
Okay.
I don't know about 3 years, but next 1.5 to 2 years, we'll definitely be increasing our volumes quarter on quarter, even without the existing land.
Perfect. Thank you. The next question, final question, in fact, and I really appreciate the way Ashlesh bhai, you and as well as promoter picked up at around all-time low price of 120 onwards, all the way up to 155 plus. Now, are you still looking at increasing your stake, or it was just to support and give confidence to all of us?
No. This is skin in the game, sir. The promoter sees the potential of the company to take it further.
Perfect. No, really appreciate, and that's a great thing, giving us confidence to be in together for longer period. So appreciate, all the very best, and thank you once again, Ashlesh bhai as well as Indrajit.
Thank you.
Thank you so much.
Thank you. The next question is from the line of Mr. Rahil S. from Sapphire Capital. Please go ahead.
Hi, sir. Good morning. Can you hear me?
Yeah.
Yes, sir. Hi. So firstly, the other segments in the lubricants and PIO, what is the outlook there? I mean, what is the current market scenario there? You said transformer oil is not doing as well as expected in the market. So any reason for that?
No, I never said transformer is not doing well in the market. I told there are delinquencies in debtor collection in terms of the transformer business because of the power sector it is associated with.
Okay.
And for the lubricant, obviously, it is growing at a stable pace. I mean, with the advent of EV, obviously, automotive lubricant demand, obviously would come down over the years. But for at least for industrial lubricant, obviously the demand will keep on rising with increasing economy.
Just to clarify, what Ashlesh bhai meant is that transformer oils is a growing segment. With the increase in electrification, with the electricity around, it is something which blocks a lot of working capital because of its debtors.
Okay, sir. And you said the other expenses were, much lower this quarter, which is a good sign. But the major component which led to that was the changes in freight rates, correct? Which you say are pretty stable as of now. But let's say they turn volatile given the geopolitical conditions. So how do you still expect to maintain or improve your gross margins?
See, post this issue, we have been, in a position to pass on the increase in freight rates to our customers. And currently, we are doing lots of shipments on FOB, so freight is being arranged by the customers. So this has helped us in, navigating the freight, sudden freight hikes, if any, going forward.
You have that sort of arrangement with all your customers?
Majority of the customers. I cannot say all the customers, but majority of the customers.
Okay. So by and large, you will be able to, keep your gross margins at the range of double digit at least. Can we expect that from the next quarter itself, from quarter 4?
We are very optimistic about it.
Okay. And finally, sir, if you can guide on revenue front, any specific guidance do you have, or what do you expect, like a growth CAGR for the next 2-3 years, you expect to achieve?
Our annual budgeting for the next year is on the way. This is in February. So hopefully, maybe next call it will be easier for me to give you much more clarity on what would be the guidance number for the year coming ahead.
Right. Okay, sir. Thank you and all the best.
Thank you. The next question is from the line of Mr. Prateek Shah from Investing Alpha. Please go ahead.
Hello. Yeah, hi, good morning, sir. Thank you for the opportunity. So my first question is, the PHPO continues to be the largest contributor to the finished goods revenue. So how should we think about the growth trajectory at this segment, over the medium term?
See, the FMCG industry, as you are aware, PHPO is a combination. We are dependent on our customers, to grow. That's a very basic line. But obviously, the FMCG industry has not been growing so well over last 2 years. But obviously, with the liquidity in the system, with the GST rate. Hello, can you hear me?
Yes, we can hear you.
Okay. Yeah. So with the GST reforms that has been there in the country, by the Honorable Prime Minister, we are very hopeful that FMCG and the consumption demand, specifically in the rural areas and the urban areas, will start coming up, from this quarter. We are very hopeful, and with the discussions that we have with our customers, they are also pretty optimistic that things will turn around earlier than expected. So we are very hopeful that the PHPO and the cosmetic industry will continue growing at the way in the near future in at least a high single digit. Plus we are also dependent on our exports for our PHPO business as well. So not only on domestic front but also export front, we are anticipating to increase our revenue from our overseas customers.
Okay, so are we seeing a higher growth from existing customer itself, or any incremental contribution from newer accounts or any specific geographies that we are targeting?
It's a combination of both the things. Obviously, like our existing customers, are showing some growth. Plus, we are, penetrating with our existing customers. So with some of our multinational companies, currently we are only supplying to India market. Now we are supplying, these multinational customers to our overseas market as well. So that's why we are penetrating with these customers and, growing internally.
Okay. So one last question. So exports now form a meaningful share of our overall revenue. So which regions are you currently driving this growth?
No. What was the question? Minuscule. It is about 45%. Overseas sales is about 45% of total turnover.
Right. So I'm just asking, which regions are currently driving this growth?
Obviously, it is Asia Pacific and some specific countries in Africa which are driving this growth.
Okay. And should we expect the export mix to remain broadly stable, or do you see certain markets getting faster over the next couple of years?
See, obviously, with the announcement of deal, coming forward with the US, obviously we may anticipate US would, accelerate in terms of growth. With the EU trade deal just done, we are still working on the numbers and the benefits that our customers will have in the European region. Then, the landscape would definitely change. It's difficult for me to give you a number now, but we are anticipating the landscape to be changed very soon.
Okay. Thank you, sir. Thank you for the opportunity.
Thank you. The next question is from the line of Mr. Vivek Gupta from Star Investments. Please go ahead.
Hello, am I audible?
Yeah.
Yeah, hi, sir. So the working capital levels appears elevated in recent periods. Is this largely driven by business growth and inventory planning?
Levels. There has been a general increase about 3-4 days in inventory and about 4-5 days in receivables. But in the same breath, what was happening earlier was my creditors levels was coming down. This year we've been able to keep it at normal. So if I take all that, my cash conversion cycle this quarter is slightly better than the previous quarter, and we expect it to be around the same levels as this quarter.
Okay. So, like, should we expect working capital intensity to moderate as volumes stabilize?
No. So, just to answer your question specifically, we are not in that game where we stock inventories. Among the peers, we have the least amount of inventories. Hence, there is no impact of inventory gain or inventory loss. We are not very high on the transformer oil business, so my debtors will still stay within that 65-70 days. So I don't see any increase in the working capital with the increase in turnover. It will stay around the same days.
Okay. So, like you cater to both the large FMCG players and broad customer base. So, like, how do you, balance scale customers versus the diversification?
Obviously, there are channels in place, to take care of our small customers as well and large size customers as well. Obviously, with international clients, the buying is more, the buying is more specific. There are budgeting in place. There are quarterly forecasting in place. Which helps us in planning better. This way, it's easier for us, to penetrate with these customers and grow with the customers.
Okay, so like just a follow up on this, like does onboarding large customers typically translates into multi-product opportunities over time?
Yes, it does. It does.
Okay, sir. Thank you.
Thank you. The next question is from the line of Mr. Rajesh Agrawal from Money Or. Please go ahead.
Sir, my question is the business sequentially we have not done so well, yearly we have done well. Is the business seasonal in nature? That is the first question.
There's a bit of cyclical impact.
Little bit of cyclical impact. I mean, if you see our revenue, quarter on quarter, it is primarily, range bound. I mean, there's not a huge volatility like, say 500 crores in one quarter and 1,000 crores in other quarter. It's not like that. It's still range bound, but yes, I mean, post monsoons, during monsoon, the business is little bit low, but I mean, quarter 3 and quarter 4 are better numbers, better performing quarters for us historically. So we are looking for.
And the next question is the demand from FMCG for the cream products like white oil or personal products. That is a good demand driver, because I was reading a report by Nielsen are our products used for hair cream and cosmetics?
So what is your question?
My question is our product being used for hair cream, main products, and cosmetic products?
See, the application of our white oils is across various industries. For cosmetic industry, yes, it's used in manufacturing of creams, lotions, and stuff like that. In pharmaceutical as well, it's used in manufacturing of your creams, ointments, and so on. And also in like various, like for example, say various manufacturers are there, like the Tiger or Vicks Vapor and so on. This is where the application for products are.
Okay. So how is the demand holding there? Are you seeing good demand from there?
I mean, it's not a healthy demand, but demand is at least better than last year.
Last year, it's better than last year. And going forward, do you feel the demand will come from there? No, that's
we are anticipating demand uptake happening, just highlighted in our previous discussions.
Okay. Thank you, sir. That's it.
Thank you. A reminder to all the participants who wish to ask a question, you may press star and 1 at this time. The next question is from the line of Mr. Rohit from iThought PMS. Please go ahead.
Am I audible?
Yeah, audible.
So just wanted to understand what is the peak revenue that we can do from our current capacity of 6 lakhs kiloliters?
Sorry, peak?
Revenue. Yeah, I'll tell you. So 6 lakh kiloliters, there is another 30% of 2,25,000 KL which can be increased when the Sharjah plant comes onto stream and becomes close to about 100%. So that is the highest we can do right now. With the existing installed capacity. So that's about another 60,000 KL.
So you're saying 6,60,000 is what you can do at peak? I mean, if you can use...
No, not 6,60,000. No. 5 lakhs is the 6 lakhs is the total installed capacity. So
right.
another 30% increase, another 30% of 20, so 60,000 will come up by the next 2 years or so.
And in terms of revenue, sir, how should we look at it? I know prices are fluctuating, but just generally, maybe at current prices, what can we do as a peak revenue?
7,800 rupees per liter, or 7,800 rupees or 7,500 rupees per kiloliter.
Got it. Okay, so got it. And hence maybe you're looking at expanding the capacity. And on this exports, so while exports are a big contributor in terms of revenue, but I also wanted to just check, like over the last 3-4 years, we have been range bound around that 140, 150 crores. Of course, this year we'll probably hit around 170, 180 crores. But in exports, like what is the, what do you think can be the potential? Can this be like 50-70% of revenues, let's say 3-4 years out, or it will be more steady and the share of revenues will be around these levels only?
So we probably exports could go up by another 5-10%. It will not be 60-70% of total revenues. So it could be 50-55%. That's what we see in the short medium term.
And are they better margins and better? Return on capital wise, they are better or they are similar?
Slightly better. Exports gets us slightly better margins.
And working capital also is similar there, sir, in terms of your receivables, etc.
Yeah. Receivables is around the 60 odd days. But exports in working capital is slightly better because we work on a lot of advance and against LCs. So debtors is slightly better managed over there.
Got it. Okay. And the last question, in terms of your product profile, is there anything that you're doing to sort of improve your product profile or differentiate, let's say, maybe only very specific formulations for a specific customer or a specific suite of products? Is there something that you're doing there, or you may want to talk about something on that line, or?
Yeah, definitely we are, in close interaction with a few of our multinational customers where we are formulating a specific product for them, but these are still under R&D trials because of the NDAs. It's difficult for me to, give more further information. But yes, there are some new products which are being worked with the customers.
Okay. And at this point of time, what portion of revenue would be such products, or?
No, these are the new products which are under development, right? So there will be no such revenue generated as of now from these products.
Okay. So, what I wanted to understand was, sir, that, typically if the products are differentiated or if there is a very lot of R&D that we have done with the customer and we are closely sort of tied in with them, then it will be, we'll be probably the sole supplier or one of the sole suppliers or one of the key suppliers for them. So right now, do we have such revenue in the system, like such?
Yeah,
and what would be the share of such?
There are a few products, yes, where we are sole suppliers, to some certain specific customers. The revenue, in the overall scheme of things, would be far minimum. But if you ask on the FMCG point of view, obviously, with some specific product would be in the range of 7 to 8% of the total revenue on the PHPO products.
Got it. Got it. Okay. Thank you very much, sir. This is all I had. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Ms. Ayushi Gupta for closing comments.
I would like to thank the management for taking the time out for the conference call today and also thank all the participants. If you have any queries, please feel free to contact us. We are MUFG In-Time Private Limited, Investor Relation Advisors for Gandhar Oil Refinery India Limited. Thank you so much.
On behalf of Gandhar Oil Refinery India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.